The Brompton European Dividend Growth ETF is an actively managed portfolio of dividend growers based in Europe. Dividend growers tend to outperform over time with less volatility, and that's because they're stable companies with growing businesses that do a great job allocating capital. They grow their free cash flow and distributions to shareholders. The strategy uses a macro top-down sector allocation, and then we pick the best dividend growers in those sectors. The fund is designed for investors seeking both a combination of income and growth. We use an active covered call strategy to supplement dividends received on the portfolio holdings. This is difficult for investors to do on their own since investors really can't write calls on European stocks. It also means we can pay out a higher distribution relative to typical European funds. And the strategy also helps reduce overall portfolio volatility. So why Europe? Funds flows are returning to Europe, and that's because number one, valuations are very attractive. They have very high free cash flow yields and low price to earning ratios, especially relative to the United States. In the past, Europe deserved to trade at a discount to the US because they had higher political risk, lower growth, lower return on capital, and return on equity than the United States. But this is starting to change. So first of all, from a political standpoint, we've seen that the European experiment has survived. Greece, Italy, and Spain have not left Europe. And if anything, post-COVID, there's been greater integration. The European Union has a recovery fund that's around 2 trillion euros of financial firepower that's just going to start getting running in 2022. And there's also a $1 trillion Green Deal investment plan that will be invested over the next decade. So green stimulus will help increase overall economic growth. The other things that will help are the European Central Bank is actually likely to maintain the quantitative easing well throughout 2022, and they're behind the US Federal Reserve in increasing interest rates. We're also seeing greater deficit spending with Angela Merkel retiring as Chancellor of Germany, and this is incentivizing increased deficit spending throughout Europe. From a stock point of view, we're seeing greater share buybacks, more activists, and there is more fat to trim in Europe. More inflation will boost sales and earnings. There's also fewer regulatory headwinds, particularly in the banking sector. We also see, in general, higher environmental, social, and governance rankings in the global peers. We also see that there's potential for bigger bounce backs in earnings per share, especially in light of the possibility of higher corporate taxes in the United States. And earnings do drive markets.